Hello and welcome to today's extensive weekend video, which is called Is the Japanese yen, Japanese government bond yields, are they going to be crashing American stocks? What was Friday all about? We'll dive into the data together. Let's examine the flagship August 2024 situation run-up, how it had been looking across the markets, what were the effects on risk-taking in general in the States and across the globe, and compare the situation to where we are right now. It will take a lot of fearful approach away from the markets, and we will get a more reasonable view of what is currently unfolding and what are the drivers. So let's start with comparing then to now, and then I will dive into the current situation in US equities, including sectors, of course. So this is going to be the well-rounded view that you are pretty used to be getting from me, whether you are a free subscriber on the site where I'm giving you from time to time a peek under the hood, or whether you are a premium client that has direct access to myself all the time, one-on-one, direct support for your own individual success, which is what comes first. Thank you for liking this video and subscribing to the channel, it helps greatly. Thank you as well for comments as to what you would like me to be covering next for you. So let's see what had been the run-up to the early August, the memorable early August Monday flush. If I remember correctly, it was August 5. How was the preceding situation looking? We got a notable appreciation of the Japanese yen. It was quite an acceleration after the steady depreciation that we had been used to from the Bank of Japan. Needless to say that markets did not take quite well to the defense of the roughly 1% yield on their short duration bonds. This is the view of the 10-year Japanese government bond yield, how it had been performing in the early August flush. Did it retreat? Did it cause more concern? Or the Bank of Japan sought to reassure markets very fast that they are not that and they're not that serious, that they would take a measured approach. Exactly, they did the second take it easy, we are going to go slow and not disrupt financial markets route. And that's why we had seen such a steep recovery in S&P 500 as well. Of course, the US incoming data of that time were highly supportive of that too. What was the July peak? It was the first rotation into Russell 2000 out of Max 7 stocks on the inflation reading. That was the driving force back then, and we had seen a very fast return to normal. So this is quite clear illustration that the yen carry trade unwinding had not been a palpable lasting concern. Lasting. This is the key takeaway from that. It was not meant to sink the markets and to be a boot on their face. Nasdaq, it had somewhat underperformed at that time, and it is quite reasonable to expect that Max 7 stocks at nosebleed PE at nosebleed valuations that they are trading now at, that these are going to be affected. We will examine this hypothesis with the current charts. So this is still the view of August 2024. Preceding to that steep market sell-off, to that steep S&P 500 crash early August, we had seen that long-dated treasuries had been appreciating sharply. We had seen a fast quickening move to the upside. However, has that calmed down? When did the Fed step in with a solid rate cut there first? It was only in September, and you may remember that I was calling for them to miss those warning signs in July and not to cut, while they did cut 50 basis points in September, which was what I called back then for clients too. So there you have it. It's very important to read not just what the markets are telling, but what the policymakers and their likely responses are going to be. So, given how fast in August 2024 Bank of Japan stepped back from their defense of the bond yield, which is of course burning a hole in balance sheets of the banking sector. Norinchukin is quite a notable example. It had been hitting the headlines over the months, can kicked down the road for a few times. Now it's getting back with the resignation of the CEO. It's kind of like Credit Suisse in autumn 2022, if you remember that situation. It had been likewise solved. Do you think that Bank of Japan is ignoring that situation after August 2024 experience? Hell no, it is not. They are ready for that, and I bet that with all the Doge-driven and Trump-driven move towards transparency, efficiency, auditing from Fort Knox going into IRS and so on, do you think that the Fed would let Japanese situation to get out of hand? You may remember that even during the Great Financial Crisis, swap lines had been open to whichever systemically important bank needed that, and Japanese market is very deep and it needs that support. And of course, yen carry trade had been used throughout the decades because it was Bank of Japan that first went into negative yields, that first started quantitative easing well before Bernanke did it during the Great Financial Crisis. So they are on it and they are monitoring the risks, and within these charts I will show you what's the market perceived and actual danger stemming from the current situation, whether we have something to fear or not really, and what are the drivers of Friday's move in S&P 500. So let's continue with short-dated treasuries. This is the ticker symbol for 1 to 3 years duration of treasuries, and you can see how money had been increasingly going into debt, short-dated treasuries, bond fund, and these instruments. memorize this chart. It will be very useful because this is one of the early warning signs that I would see if this Japanese situation is to get out of hand, truly get out of hand. Forget about clickbaitish presentations, one-liners, two-liners, driving engagement. No, let's take it seriously and let's go through the charts. Crude oil. It can be thought of as one of the risk-on plays and inflation hedging plays. Is this something where we would see liquidation of those parked funds when Japanese government bonds were serving as a source of financing? Is crude oil breaking down? Are commodities breaking down? This is the ticker symbol for base metals. We see that they had been quite steadily deteriorating in the preceding period when the Japanese yen had been appreciating. So it was more or less driven by the forex realm, by the currency exchange rate. And we see as well quite a steep, almost V-shaped recovery in base metals back then. Agri-foods, DBA, had been as well quite untouched by the early August market panic. VIX, that's a very different story. We saw a long basing period, a steady build-up from the second part of July, and then rush to the exit door, happening over 3 days in a sense, or 2 days if you count only the breakout above 20. Look at where we are now in VIX. See how well it had retreated just as fast as it went up. Okay, a little bit slower, but it had descended. So clear market calming steps had been taken by the key players. Bank of Japan stepped back and the situation was getting resolved. VIX to forward-looking VIX. Another classic example of diffusion of risk, not diffusion, but DE. Nothing to fear. Bond market volatility. You see that bonds would be panicking even back then? No, they did not. Bond market volatility was not going out of the historic bounds, and if you remember, early April had been a corrective period in S&P 500. So obviously this was somewhat tied more to internal US economic performance data factors, liquidity, Fed policy. So Japan is beautiful, everything, but let's stay focused on what truly matters at the moment, what markets are telling us. So these are the current charts. Are we seeing very rapid period of yen appreciation? I am on the record as saying that thus far it had been quite orderly. You can compare that to the levels where we had been in August 2024 and July. It was from 161 and the bottom wick touched 142 yen to $1. We are nowhere near that. This is still quite orderly, and even before tariffs reached the very prime slot on the mainstream in early December following the elections. This is right where the Japanese yen is right now. So thus far, this has not tightened the screws significantly. This is a different problem, and this is a Japanese internal problem of what it does to their banks, balance sheets, or any other financial institutions that are not classified as banks. Of course, you know, and I've been as well covering, that this week's Japan inflation data had come solidly on the upside surprise. So, again, this is a matter of whether Japan would continue the controlled devaluation with a rip here or there, or whether it would step more forcefully towards towards defense of their currency in order to help bring down inflation, because Japan is importing a lot of its inputs. Thus far, we are seeing indeed a drive towards policy normalization, and this is how I would interpret this chart ever since October and late 2024. They are taking increasing steps towards stepping away from the Bank of Japan being the key player in keeping a lid on bond yields. Do we see a panic here, or is this as well an orderly chart? Only since February it had somewhat accelerated. However, will it last? Will it continue tightening the screws? This is one of the other charts to watch. S&P 500. We see sideways consolidation, and after quite a few Fridays, we had seen a down Friday, what has been uncharacteristic of this day, and this is what I had described not in the first presentation of yesterday that I uploaded as usual some 2 hours before the US market opened, but during the session, highlighting what would be the reasonable way to play it for day traders or swing traders, what were the things that I had been looking at that time, what basically allowed me to be ringing the warning bells before the market opened, expecting a retail flush at the in the opening hour, which of course got out of hand with the stagflationary wave of University of Michigan data, again rising consumer inflation expectations, together with slowing down services and manufacturing just now ticking above neutral. This is way too low at the moment to assure the markets of no very meaningful deceleration of economic growth. But as well, I do think that these troubles will be worked off. We have to examine the VIX that I will show you in the following slides. We have to distinguish that and compare properly the current situation, the macro outlook of the Fed being basically forced by sticky inflation, by rising inflation. I had called for this inflation to be long in the tooth and over in autumn 2024, and yes, we had seen CPI made a bottom in September 2024, and since then it's slowly drifting higher. Right now it's hitting a little bit of a plateau, and it will give the Fed one more excuse, but that's a subject for some other presentations. So sticking with diving into Friday's decline in S&P 500, this was a result of US incoming data. It's quite clear from the prior look at Japan that this is not what we are facing right now. Of course, have a look at the volume, examine where the supports are. A rising trend line can be drawn from August all the way to early January, connecting those bottoms. There is some way to go. We can draw horizontal supports, and that was basically what allowed me to play the leading hypothesis that had worked so often in the past of buying the dip and setting technically correct stop losses. This is the meat and potatoes work that is being done for clients, whether they are swing or intraday. This is a very fast-paced market, the headline sensitive. All it takes is one or two mean tweets or Elon Musk statement, and markets do move. We are getting, for example, lumber tariffs to be applied to Canada, 25%. So this is going to be having quite an effect too. Plus, Trump is in no way done with China or with solving the East European situation. Have a look at Nasdaq. If you compare that to the preceding chart, wouldn't it look to be kind of leading in the last couple of not just days? There is some kind of a budding outperformance in Nasdaq. Would you see that in other sectors? You know pretty well that I had talked financials. Would financials be among the top performing sectors? And note, you cannot have a bull market that is missing financials or tech leadership. For 1 or 2 days, energy can step to the plate, but that's a kind of a stopgap measure. No sustainable bull market can be driven by energy, by oil, by materials. Not really, not at all. But we are having what I had been terming all the way through very reasonable rotations, broadening breadth. These are not the narratives, these are what the charts are telling us. Let's have a look at TLT, long-dated treasuries. Do you see some kind of a rush to the exit door to park money safely? Even Friday's beat is so tame. Also, if you look at the volume, no, there is no panic. This is not at all comparable to August 2024. Short-dated bonds. This is the 1 till 3 year aggregate of treasuries. Here we are seeing some kind of an appreciation, but compare it to the pre-election peaks. Is this a steep acceleration to the upside? No, it's kind of simmering. It's not boiling. It's orderly, just like what I had told you regarding the Japanese yen. Crude oil meandering sideways, and this has more to do with geopolitics, the question of Iranian embargoes, of Russian oil hitting the markets, of Saudi production increases that Trump is demanding, of the Wesent 333 doctrine. This is more indicative of that. Drill, baby drill, is not going to be that easy. which was what I had called prior weekend, and so on and so on. That's why I delivered to clients the steady daily track of gold appreciation followed by pause, slight decline, going for highs again, and for oil to be tanking. Is this a one-day development, one-day panic, or something more? Is this a high base? I would be getting really worried only if we start breaking below the September floor. Will it happen? Can it happen? Not this soon, not at all. One more look at base metals. This is what not just copper is part of. Do we see some kind of risk of sentiment in here? No, commodities and so on, they are underpinned with as well Chinese stimulus. Finally, the support measures and the drive to develop Chinese domestic consumption is not being dumped. At least I'm looking at Hong Kong right now. So this is still looking very much okay, and this is nothing to be worried about when it comes to the yen carry trade unwound and fears of a new market crisis coming from Japan and spilling over across asset classes. Even agri-foods, which had been part of what I had been bullish long-term about, this is more connected to the steep pressure applied to make parties and the Eastern European war. This is more kind of a corrective move being forced by that macro situation. Let's have a look at weeks. Do we see some kind of a build-up, high plateau from which it refuses to retreat? No. Even this peak of Friday is way below this volatility crash. This is continuing, and this is emblematic of a larger bull market, cyclical bull market, if you will. So this is nothing approximating the steep spike of August, which is shown on the left side. When it comes to, again, weeks compared to forward-looking weeks, which are expectations about future volatility, I find it useful to be looking at this ratio as well. We see no rush to the panic door. This is just white noise. It is a statistical term, meaning that this is totally permissible and not indicative of any directional interpretation. Bond market volatility. Is it rising? Heck no. Again, this is the same story as before. So, having examined all of these, the current situation is in the budding stages. If you remember, the February to March 2009, if you had been trading back then, the situation of Bernanke calling for seeing green shoots in the economy, this is about as premature. Yeah. So I don't see a danger from the rising east. These are not the 1980s where we would need this kind of fear, even in our financial markets niche, not at all. So now the third part of this extensive video is going to be about S&P 500 and equities at large. So this is the market breadth view. It's not been really as disastrous as it looks. it's respecting thus far, after having broken through a series of very nearly placed supports, starting from 6135, 6125, 6115, and then my ultimate support of 6088 to low 6090s did not stop selling, and that selling continued. Again, this is what I had talked in yesterday's second video, so I will be linking to it. You can see that this is just a daily correction. Nasdaq, is it natural that it is hit harder? Yes, Max 7 are going to be hit harder, but this is a feature, this is not a bug. This is a feature of broadening market breadth, where it's drifting sideways, going up, then taking a steep dive, and then recovering, where the real moves are happening inside the index, within the sectors. Have a look at this chart. 2 weeks ago, I brought up the weekly bullish flag. We got a break out to the upside. Now, this is an engulfing candle on the weekly. Is it accompanied by such a stark deterioration of market breadth? Yeah, there is some. What does the volume say? Is it likely to continue? It can, it has the potential. However, what's more important than anything is to be examining the warning signs, their progression, the build-up in tensions, the build-up in divergences, whether they are bullish or bearish, and now those bearish ones prevail. But it's similar as to the bottoming process or the topping process. Divergences can go on for a long time and work themselves off, and this can exactly happen like that, which is why it's so important to keep the pulse on the market moves on a daily basis. Therefore, those who have full access to my daily and intraday thoughts and combine that, or at least the daily analytics unrestricted, and or depending on what and how they trade, the intraday channel. These are going to come on top because this is part of the game, whether supports have broken, resistances, what has been overcome, what has not, what are the next targets, drivers of current data, and so on. Have a look at this sectoral view. This is one day, and I am on the record as saying that this is actually day 3 of really risk of positioning, risk of sectoral positioning. We see high beta being quite hit, but again, discretionaries, whether from retail. You remember how I dived for you into Walmart and interpreting their earnings, what this had done, how this is connected to those University of Michigan data coming in. You remember that one of the prior Fridays inflation expectations did likewise sink markets, and this is the difference between whereas a retail place, discretionary place, where those on the high end in Europe are in a somewhat different positioning, but again, this is tying to the upcoming peace dividend. So this is the risk of view of a single day, where you see utilities somewhat even real estate and of course healthcare with staples as those most worthy of your attention, and on a weekly basis we see that exactly it's staples, healthcare, utilities and real estate. So even the weekly view of sectors had been very risk off. So let's approach the situation rationally without fearful emotions and take it for what it is: risk of turn, ongoing rotations, and what is being prepared inside, even inside tech. Because some days semis for AI, other days it's cloud or software that are leading, and you jump from one sector to the other. And this is the sense of when we are seeing such a relatively tight range and trouble overcoming the 6,000, say 50, let's totally round it to a non-technical level, overcoming. Thus far we are not there, but are we going to have a good year in equities? Yes, of course, we are going to be closing closer to 7,000 than to 6,000, which is a pretty surefire bet. So that was my 2025 outlook. So let's take it for what it is: a risk of turn in the markets that is lasting unusually long, and we did not have institutional buying before the close, which is odd, and the only differentiating point if you compare prior risk of days to risk of Friday. And again, this was driven by the deflationary data, so it will be most insightful to see when institutions step in again to the buying plate. And have they been retreating? No. I would again say that this decline Friday was more driven by retail panic than by smart money panic. It can be easily shown with data. You know my join page where I will be where you can go through the opening description that will help you select what's right for you based on what and how you trade. And I strongly highlight having full real-time access to my daily analytics together with intraday commentaries and the ability to ping me one-on-one via Telegram for my fastest reply. And that's what's in it for you. My professional journey, you know very well, infographic why I can be looking at such with such an esteem at certain events. Obligatory disclaimer. Thank you, have a beautiful weekend, and let's talk soon. Thanks again for likes on this extensive video.